Welcome to lesson 7.2 on maximizing our valuation for a potential business exit. In this lesson, we're going to be going through uh, basically all the lessons that I wish I knew prior to trying to sell a business. I had no idea what was involved with it. And the first time I sold a business, it was uh, a very drawn out process that could have been much shorter. Like in the grand scheme of things, the businesses that we're building, and we'll talk about like when's the right time to sell, what you need to have in place beforehand. But roughly, like a couple $1 million a year business is not that sizable of an exit. It's not. That's not to say it's not exciting or like a major accomplishment because it definitely is. But the amount of work that goes into it is I made it a lot harder on myself by not knowing these things first. And so here we are in stage 7, $1 million plus. And at this point, we should have made at least a consistent $1 million in sales. We've automated our systems. We've started to build up some brand equity or recognition. And we have consistent sales where it's spread between like email, Facebook, Google, organic, and affiliates. And by the end of this lesson, we'll understand how to prepare your business for a sale and learn every step of the exit process for your business. Now, this is not like an exact guide, like just check these boxes and your business will be sold, because it's a very, very involved process. But the reason that this matters is that preparing for potential exits lets your business look very appealing and sellable to buyers, not just for potential buyers when you decide to sell, but even as you're just running the business. These are good practices to be in the habit of that just makes the business like one that, it's kind of like if you, when you go to say you've lived in a house for a long time, then you decide that you want to sell it. And then when you start fixing it up and do all these renovations and stuff on it, and then once you are done with all the renovations, you're like, actually, I kind of like it here. I don't think I want to sell it. We can do that for your business right now. So if you remember when you first started, like everything up until this point was about building a sellable business. But when do you prepare to sell your business? The right answer is right from the very beginning, because all the things that are involved with selling your business one-on-one is number one, preparing all the right documentation. 2 is coming up with a formal valuation. 3 is your exit strategy. 4, preparing your business to sell. 5, going to market and buyer communications. Then 6, receiving LOIs and due diligence. And then 7 is closing and transition. And in the last course, we split this up in a bunch of little lessons. We're just covering it all right now. So for preparing documentation, you need to have your SOPs, your financials, and all your brand assets nice and organized. And picture if a potential buyer was looking at your business and they asked to have the keys, like it should be extremely easy for you to hand that over to them. Like you should be able to basically just send them like a Google Drive, and it has everything so nicely organized that anybody could pick it up and understand exactly what everything is and what needs to be done in the business. That's the point that it needs to get to. And for a valuation standpoint, like a formal valuation, like if you're like a C Corp, you need like a 409A valuation. It's not like that. It's not like a tax or legal document or anything, but you need to come up with the valuation of like roughly what the business is worth. And this is a screenshot of some slides from our pitch deck that we put together for one of the businesses that we were selling. But in coming up with the valuation of your business, the way that it's calculated is it's off of, so a couple of things. One, the majority of business sales are asset sales. They're not stock sales. Common misconception. At least e-commerce businesses of this size, they're all just about asset sales, meaning that the buyer is buying your site, your products, and your customer list, and like your ad account. They're buying those standalone assets. They're not buying like your actual LLC. They're not buying like your credit cards and your bank accounts and your EIN and all that's all separate. The buyer, and the reason it's done that way is the buyers don't want that. They don't want to take on like the potential risk or liabilities that may be associated with that LLC. They just don't want to, they don't want that headache. But the way it's an asset sale. And the other thing to know is that the accounting method you have to use is something called accrual. So there's cash-based and there's accrual-based accounting. And I didn't know this for too long. Cash base is, which you can just Google this. This is common like accounting or bookkeeping definitions, but accrual base is when, or I'll say cash base first. Cash base is just when money in, money out. That's the month that it's counted in. So if you paid for a Shopify annual subscription in December, then, and that would say it's just $1,000, that would be negative $1,000 in December. And then it would be $0 for your Shopify expense for the rest of the year, which is not like an accurate representation of how that should really be distributed. But some businesses do it on cash basis. Similarly, like if you have your Printify, say you did a really big day sales wise on the last day of the month. Well, that Printify expense, say you did like 10 grand in sales, that Printify expense isn't going to hit until the first of the next month. So December looks like it has $10,000 in sales from that last day, but $0 in cost of goods for that day, which would be a pretty big discrepancy. And the way that the buyer wants to see it is they want to see, like using the Shopify annual subscription first as an example, they want to see that annual subscription split out evenly across all of the months. So if it's $1,000, 1,000 divided by 12, like 80 something bucks a month, that's the amount that needs to be spread evenly across every month. Then in terms of like your cost of goods, for example, that needs to be shown like that $10,000, even if the cost of goods for that 10 grand in sales hit in January, it needs to be reflected or captured for December, which is a massive headache if you're doing all that retroactively, which is why I stress the point of keep track of your finances every step of the way. Run a daily P&L and then also run a monthly P&L at the end of each month. So you should have daily is just like each day, and then your monthly one is when you take the invoice statements from Printify or whatever fulfillment provider and you plug in that final invoiced amount as the cost of goods. Because once you get into due diligence, which we're going to talk about in a second, the buyer is going to be asking for backup or proof for all of the numbers, which is, it just makes sense. Like they want to validate everything that you're saying. And backing up a second, something in terms of like getting ready to sell the business, I think that I had a preconceived notion that like just if we have a business that's, decent size and has some profit, that somebody will buy it, like somebody will want it. And the answer is no. Like you have to build a business that somebody would actually want. And like investors are not idiots. So if you have a business that you're not that happy about running, why would a buyer be any happier? Like they're going to have your unhappiness compounded by the fact that they have all the learning curve of like learning how to run your business. So it has to be a business that is actually generating cash flow, positive cash flow, and doesn't have a ton of key man risk, meaning that you are the entire business. If you're the person who is, and that's going to be one of the questions they definitely ask you is what is what does your day-to-day involvement look like in the business? And if like obviously you have to answer honestly. If your answer is, well, I run the ads and I make all the design decisions and I'm answering customer service tickets and this and this and that, like no buyer likes to hear that unless if you're coming along as part of the deal, which to me, I was never interested in. I never wanted to be like hired and then I'm basically just getting a job. So the business needs to be like it's calculated accrual method, asset sale, and the valuation method is by looking at what's called TTM EBITDA. So trailing 12-month earnings before interest, taxes, depreciation, and amortization. So like roughly your net profit over the last 12 months. And in terms of valuation, it helps your valuation a ton if your growth trajectory is trending upwards by at least 15 to 20% year over year. If you are stagnant or flatline or even worse, declining, that's a massive red flag for a potential acquirer. So the ideal time to sell a business is one, get ready from the very beginning, but then two is when you have a business that's done at least $1 million in sales, has at least a year of history, at least a year of history and $1 million in sales, and is going like this. Ideal, like most business sales, and where you'll like peak the interest of like a larger potential like buyer pool is when you're at the 1 to 2 million in EBITDA. So that's 1 to 2 million in trailing 12 month net profit. So that's the real point that most buyers get interested. And but it's still possible. Like companies like Open Store exist to acquire companies, Shopify brands exactly like that. And I guess we could talk a little bit about like potential buyers. There's aggregators, there's like family offices, which they wouldn't really be that interested. There's strategic acquirers like Yoga State. If we got acquired by like Gaiam or something, somebody who already has a large yoga customer base. And then there's like selling like direct to, like a mom and pop shop, not a family office, but like a mom and pop shop of like somebody who's just, working a 9 to 5, has built up like a pretty decent nest egg and is looking to get into e-commerce. And then rather than, learning it all themselves and like getting started from zero, they're looking to just acquire somebody. So there's lots of different options, but the bigger buyers, you won't really pique their interest until you're at least 1 million in trailing 12-month EBITDA, closer to 2 to 3. So In coming up with the formal valuation, it really helps to put together like a slide deck, like this one that we put together for our brands, where you map out like all the potential business opportunities, like expansion opportunities, how strong the brand is, your marketing channels, what differentiates you, why the that you're in is growing and not going to stagnate, all that sort of thing. So, for exit strategies, explore the following options. You can sell, merge, or you can scale further. Strategic partners, that was the one I was looking for, or you can just scale it further. And like if you once you have a brand that's doing over $1 million a year in sales, you're bringing home at least 150 to 250 in net profit. If you double that the next year, you're at 300 to 450 at least. Like, why not just keep doing that? And you definitely can. To me, the reason that I ended up deciding to sell my brands was that one, it had been a goal of mine for a long time, and two, it's like if I can just take chips off the table and then reinvest it in something new, that seemed like a pretty good option to me. And it completely depends on like what your goals are. And like for some people, if I was like super obsessed with yoga, or if I really loved history, then and it felt like a passion project for me, and it was something that I could see myself growing for 5 to 10 years, then yeah, then I would hold on to it. But if I had other ideas, like knowing that I wanted to get into software, like try different business opportunities at some point, just for me personally, it like always made sense to me to sell it. And I also wanted to have that experience, just like I learned a lot better by going all the way through the process of building and growing a Shopify store than I ever would have learned like from just sitting there before starting. I learned so much more getting all the way through that process. I wanted to have that same experience getting all the way through an acquisition process, because then to me that was like the full life cycle of running a business from inception all the way to acquisition. So then I had experience with all of that, was just another thought process that I had in mind. Then when you're preparing your business to sell it, there's three different ways that you can sell it. So you can either, I'll go right to left. You can either sell it yourself, which is the simplest structure wise, not necessarily like the most efficient, but sell it yourself, which is where you just go out and list it on marketplaces. Like one that I listed it on was called, so yeah, this was the marketplace that we went to find buyers. Shopify used to have a marketplace. It's called the Shopify Marketplace. They now closed it because it was filled with like just a lot of tire kickers. A lot of people that would reach out saying, "Hey, I'm very interested. Can you send me your site name and like financials?" It's like, sure. Will you sign an NDA? And the answer is always no. So you can go sell it yourself on marketplaces like this, or there's a lot of other ones, or you can go with, you can just Google them, or you can go with brokers, which brokers, it's like, I'm not even going to name some of them, but there's a lot of them that are just like used car salesmen. So there's some good ones out there, definitely. But you have to watch out for the brokers that, and the way that they work is that they essentially have a Rolodex of potential buyers that they've worked with in the past, and they partner with you. They help you fix up like your listing and stuff like that and come to a reasonable valuation. And then they go out, the idea is that they go out to their list of buyers and that they find you a potential buyer, at least get you conversations very quickly. The commission structure is normally tiered based on the size of the deal on a percentage basis, anywhere from like 10 to 20%. I can't even remember what percentage we paid now, but yeah, so that they take a percentage of whatever the final business valuation is. And the larger the deal size, the smaller the percentage they take. But you just have to talk to a bunch of them before you end up settling on one, because it's a really important decision. You want to make sure that you're not getting somebody who's just, like I said, a used car salesman, not really going to add much value, and they're just going to take their percentage. Then investment bankers, they're kind of like brokers, just much higher quality, but they also only deal with much larger deal sizes. Like starting, at least when I was talking with them, it was starting at 2 million EBITDA and up. So those are the three different options. And then next, in terms of like going to market and your buyer communication, so you're going to write your listing, which ChatGPT can do this extremely well now. But in order to list on like Acquire, you have to write like a business synopsis, and you come up with like basically a good pitch on like why it's a good business, that there's growing opportunities, it's diversified, it's relatively hands off, all those sort of things. And it's like primed for growth because of X, Y, and Z reasons. ChatGPT can help you come up with that. Then you make the listing on like an Acquire or one of those marketplaces, and then buyers will start reaching out, asking you questions, and they'll want to just see the financials. And what I recommend doing, and what we did, is have everybody sign an NDA. So I had a, what's it called? DocuSign. So I had a DocuSign account that was just on fire. I was getting tons of messages flooding in from potential buyers. About half of them probably just wanted to see the financials, but I had all of them sign an NDA where I just used DocuSign, create a link, send them rather than having to ask them for their email and stuff. Like just send them the link, they click it, they sign it, and then you send them the financials. And the way that we sent them the financials is give them like a PDF packet where it has the slide deck that talks about the brand and then has the financials in there, but then it also has what's called a process letter. That's what this is right here. So this is not required, but this is linked somewhere around this video. But a process letter is, so like, let me back up. The stages that you go through is that you decide you're going to buy, you prepare all the financials, and then you write your listing, you get everything in order, you get your valuation, you put together your slide deck, you have your trailing 12, the full business length of the history. The full length of the business history has to be done in the financials. They're only really looking at the 12 months for the valuation, but they are looking at the whole business history. And then when they look at that past 12 months, they're going to put some kind of multiple on it, anywhere from like a 2 to a 3 to a 4, depending on the size and the growth. Like if you're growing 20 to 30%, you could get closer to like a 3.5 or a 4. If you're pretty large and you're growing at that rate, then you can get like a 5. So like if you're trailing 10 or 12-month EBITDA is like $100,000, for example, and you're like stagnant, you could be looking at like a 2 or 2.5, which would be you could sell it for 200 to 250. But if you're growing, then you could be looking at closer to a 3, which would be 300,000. And then if you're growing and you're pretty sizable, like $1 million plus at least, then you could be looking at like a 4. So it's like there's levels to it, and there's like orders of magnitude in profit to be gained off of the acquisition by just doing these things well in the beginning. And I didn't understand any of this. And then the really bad trap that I fell into was that as I was preparing to sell and like getting over this learning curve, like I didn't know what I didn't know. Like, should I go with a broker? Should I just list? Should I whatever? In hindsight, I wish that I had just listed and forgone a broker, at least in the beginning, so I could learn the process for myself, so I could manage the broker and know like what them doing a good job even looked like. And there's also no risk of me just listing it myself for a little bit. But I got caught in like analysis paralysis while I was, and also just getting over the learning curve. Meanwhile, I had to be running the business still. And because my focus was so heavily placed on selling the business's performance started to decline or stagnate at the very least. And so that's a tough conversation to have with buyers, like explaining why, the business's performance hasn't been great. So that's another learning, like make sure that you are not the key man, that you are able to have the business continue running while and growing while you're not a part of it. So back to the communication, you have them sign an NDA and you send them the materials, and included in the materials should be what's called an offer letter if you choose. You don't have to do this. We actually didn't use this, but I wish we had. Because an offer letter, basically, the template is around here, but it's basically saying like that we like the process that you're running, like the timeline of when you're willing to receive offers, which is LOIs, letters of intent, between what dates, and like the requirements that you have to meet that, and then also the information that you're requesting from them, like conditions and approvals, like if there's shareholders or like financial instruments that need to be leveraged in order for them to do the deal, like proof of funds, like all that kind of stuff. And you can ask for proof of funds or proof of like ability to pay before you even send somebody financial. It would be a completely legitimate thing to ask. But the smaller your business size and less experience you have, the less you can like really ask for. But back to the offer, the process letter. So you're giving them the deadline of when their LOI has to be in by. You're asking them to clarify like who they are, what financial instruments they would need to use in order to, buy the business, all that kind of stuff, because that's going to factor into your decision. Because say you run like a 30-day process and say that your all LOIs must be received by the end of the month. Ideally, you'll have multiple LOIs. So then you have your pick and you're able to like not just go for like the only offer, but hopefully you have multiple, and then you're able to evaluate. And some of the things you'll evaluate on, again, this is a very dense subject, so we're just going very high level here, but some of the things you might evaluate based off of are like who they are, what's the reason for them buying the business. Because for me, that was a big one. I wanted to know that the people that were buying the business had a chance, like that they were qualified to actually be successful with it. I didn't want to sell it to somebody who was like just getting into e-commerce and they needed to figure out everything, because I that would be tough for somebody to come in. It's possible, but that's something to consider. And then in terms of the financial instruments and like proof of funding, all of that stuff, that's the biggest risk, is that if you don't validate that up front or vet for that, then you end up accepting an LOI from somebody, which means you turn down the other LOIs, and then you go into a due diligence process, and then it turns out that they were not who they said they were. Which we had that happen. We had buyers that we were talking to very seriously, and then they just started acting like kind of sketchy, like they wouldn't turn their camera on Zoom calls, and like we tried to find like look up their LLC that they said they were getting the funding from, and it was like not a real LLC. Or my personal favorite was they sent a PDF like screenshot of proof of funds, and then I used the tool that shows like if PDFs have been tampered with, and it saw that like the date and this, it was something weird, but something had been edited in the screenshot, which there was no reason for it to be edited. And then we asked them about like why that happened. They just got all like clammy. And then when it finally went to like, okay, let's move forward, like let's make a formal offer and like move to the next, like we sent them to the due diligence documents, and they like never had a real follow-up question. They were just like, yeah, this looks good. I'm like, do you guys have any questions or anything? And it was just very sketchy all around. All in all, they ended up just completely ghosting us, and we never moved forward. So, lesson learned, make sure to vet them beforehand. And that's where the process letter comes in, is it's adding a sense of urgency to potential buyers, opposed to, them not having like a deadline or any kind of, not social proof, but urgency or scarcity that like this deal is temporary. They don't have like, they can't just wait for forever to decide. So that works to kind of pool up your offers, and hopefully you're getting a bunch of interest based on like, one, the quality of the business, two, the quality of your listing and the number of places you're listing, or the quality of your broker. But hopefully you field like 5 to 10 different LOIs. You pick from them. You pick the one that sounds the most legitimate, the buyer that you like the best, and you've had conversations with all of them at this point. Like the first step before an LOI is that you get on a phone call with them and just talk to them. And like selling a business is just like anything, is like about people. You need to truly get to understand and like know the buyer and like what their goals are, and like build a rapport with them. It's not just like a business transaction. It's more about like who the person is on the other side of the table. And then once you go through the LOI process, and then you go through due diligence, which we're not quite at closing and transition yet, but I like the meme. When you're in due diligence, that's when they're like lifting up the kimono and looking at everything, all your dirty laundry within the business. Hopefully you don't really have any, but if you did everything legitimately, like you obviously should, in your P&L and L and your balance sheet and all of that, and all of your numbers align with what you have backing for, and like you actually have proof, like you should have a some kind of backing, like either an invoice or a screenshot or something for every single line item of every single month for the entire business's history. Printify, for example, makes this easy. Facebook makes this easy. Google does. Shopify. So fortunately, the majority of our large providers, they already have this built in. Like you're able to go pull every invoice from every month that like in your history, but you need to have those things like ready and available. And when you're going through due diligence, you're going to get questions about like what happened in this month. Why did sales dip? What happened here? And it's not it's not a good answer to say things like, well, I got married that month, so I stopped working on the business as much. Like that's not a good answer. Another question you should be prepared for is, why are you selling? And that's a very legitimate reason as well. I mean, you don't need to BS, like especially entrepreneur investors, they get it. Like they've been in your shoes where you built something and you just want to like take a break and exit. But so be transparent and authentic throughout the entire process. That'll get you much further than anything else. But at the same time, be considering your responses and knowing that everything that you say, the buyer is evaluating like your every word. And also in the due diligence process, when we were doing this the first time through, all of our stuff was like, I got the P&L and the financials pretty organized, but then people were asking me for things like our products like distribution. I forget, they had some fancy term for it, but it's basically like our which products out of our catalog, like our ABC analysis. That's what it was, which we were print on demand, so I didn't really understand that. But that's like an inventory like cost analysis, which we didn't really have any. But anyway, yeah, they were asking questions like that. So nowadays, ask ChatGPT what are questions that I should be prepared to answer when going through due diligence for potentially selling a business, and that'll cover most of your bases. But yeah, again, this is a quick and dirty rundown of what the process entails. Most important thing, recapping everything, is at least 12 months of history, doing at least a couple $100,000 in net profit. Otherwise, you won't really pique the interest in most buyers. It's just not worth their time. And your valuation will be calculated based off of that trailing 12 profit and the growth rate and the size. So anywhere from like a 2, I know some companies that have sold for like a 1 to a 1.5, depending on how bad the business is. So you want to have a really good business that's sizable and it's growing like 20 to 30% year over year, ideally 15% minimum, definitely not flatlined. And then that's how you get your valuation. I recommend putting together some kind of pitch deck or just presentation, your asset sheet, so like your balance sheet for the whole business history, your P&L for the whole business's history. Those are all your materials together along with your process letter. Then you write your listings to go on different marketplaces, decide if you're going to work with a broker or not. But you put up your listings on different marketplaces, start fielding messages from people. When people reach out asking for the financials, you send them a NDA, which is very common practice. Any potential buyer, any legitimate potential buyer should not have any issue with that. And then when they fill it out, the fancier way is you can set up DocuSign so that when they finish filling it out, the auto response message to them sends them the materials. I thought that was fancy. Anyway, and the link that you send them is like the link to the PDF form. It has the process letter, your financials, the slide deck, all of that stuff. And the process letter tells them everything they need to know in order to submit an LOI. It tells like when, where, the valuation that you're like range that you're open to, and the information that they need to send. And then you set a process due date, like roughly a month or 45 days out. And by the end of that date, you should have hopefully at least a couple of LOIs. You pick between all of them and make sure you vet the buyers, that their financial instruments sound like legitimate and you think they can actually get the deal done. And then you decide on one, you accept, you let the other ones know that thank you, but we're evaluating like this opportunity. But make sure you don't burn any of those bridges, because worst case, the one that you go with ends up falling through. And then you go into due diligence, you share all the financials, you get riddled with questions. They ask you everything about the business. You need to have really good answers for all of them. And then normally they'll try to like retrade on the deal and try to nickel and dime. Maybe I shouldn't say normally. Sometimes they'll try to do that to try to get a better valuation for themselves. And then eventually you close. And once you close, then you go into transition. And transitioning is basically your time to make sure that you're doing right by the buyer and that you're doing everything that you can to ensure their own success. Now, the specifics of this are determined in your closing documents. Like it's negotiated, like either the amount of hours or a time frame that you'll be involved with the business's operations. And then it's also possible that they'll include some kind of earnout clause. So your earnout clause is normally like a performance bonus. Like, for example, if we were at $1 million last year, if we surpass 1.5 this next year, then you would get an extra, I don't know, $100,000, whatever it is. And it's normally, at least from what we saw, the offers range from like 60 to 70% upfront, and another like 20 to 40% were earnout. And the advice that I was told that I think is really good advice, and I still stand by it, is when you're deciding if you want to do a deal or not, you should do the deal as if with the thought in mind that the earnout will never happen. And if you're still happy with the deal, just with the upfront lump sum, then great, then go for it. But I've seen a lot of deals where that earnout just never even comes close to happening, because there's too many things that are outside of your control. Because you can only do so much when you're in helping them out. Like at a certain point, it's up to them and their team to be really motivated and organized and on top of their stuff. So those are a couple things to consider. But like I said, the transition specifics are included in the closing documents. But ultimately, it's like just the ethical thing to do right by the buyer. Do everything you can to make sure that they're successful, not just because they put a lot of trust in you and doing the deal and stuff, but also they're now taking over your brand, the thing that you put all that hard work and effort into. And yeah, you just want to make sure that you're setting that up for success as well, that it's not just going to crash and burn afterwards. And another thing to consider is what's going to happen to your team afterwards. Like for me, it was very important that the team would be either like taken care of by the new buyer, or that they would stay with us and we would keep them employed some other way. Like I was never going to do a deal where it just left anybody like laying out in the wind, hanging out in the wind, whatever the saying is. So a lot of different variables at play to keep in mind. But all in all, once you're done, it's the biggest day of my life. It felt like that, or I thought it would feel like that. And then it ended up feeling like just any other normal day. So once you get to this point, you realize that the journey is the destination, as cliche as that is. But congratulations, you've done it. You have reached the very end of the 2025 course. this has been quite the journey. I hope that you guys have enjoyed it along the way. And uh, yeah, I think this, hopefully it feels this way, that it was a big improvement over last year, and I can't wait to see all the results that you guys get with this. Um, and especially even for you guys who are watching this who are not at the $1 million level and you're just interested to learn about selling a business, then hello to you as well. And thank you all for watching very much. And I hope that you guys get a lot out of this, and that you go out and, more than like all the lessons and stuff, that you just go out and take action, and that you're okay with the fact that you're going to mess up, you're going to make a lot of mistakes, and that's 100% part of the process. The important thing is that you just don't get discouraged, and that you keep going. Uh, and like, back to the growth lesson, that you're giving yourself credit for all the progress that you're making. And just getting to the very end of this course is a massive achievement in and of itself. So, congratulations on making it this far. I want to thank you guys again for watching and hanging out with us. And yeah, we look forward to working with you. Bye.